Saransh was sitting on a sofa. He was tense and looking at something on his phone. His wife Aba asked him for dinner, but he seemed disinterested. She comes again after half an hour and found Saransh still tense. She again asked about dinner and got the same response. Then Aba inquired why he is so tense. Saransh told her that a company named Hindenburg came up with a report on Adani, and after that its shares nosedived. Now since he invested a lot in it, they have lost a lot of money. After that, even Aba got worried, as Saransh had asked her last year to break her FD and invest that money in the Adani group. Then she asked him to call Pradeep, who's a veteran share market investor. Soon, Saransh called Pradeep. Pradeep told them not to worry, as events like this are pretty common in the share market. You can avoid such situations by looking at the business fundamentals and transparency of accounting. Focusing on a few things can help you in understanding the risks associated with the company.
If you are also investing your hard-earned money in a share, then you should definitely focus on how transparent and clean is the balance sheet of a company. Also, look at how simply and transparently the company is providing the information.
Now the question is, how to check for transparency? For this, you have to focus on a few things. You need to start by looking at the debt levels of a company. Almost all the companies in the country take debt for their business. Look at the country's biggest company, Reliance. It has also taken a huge amount of debt. So taking on debt is not always bad. However, you should know the difference between good and bad debt. There are 5 parameters you can look at: debt to equity ratio, interest coverage ratio or debt service coverage ratio, pledged shares by promoters, comparison of profit margin and interest rate, companies' valuations as compared to other firms.
Question is, what's the ideal level for all these parameters? So, let's look at all these parameters in detail. First parameter is debt to equity ratio. For this, divide the company's total debt with its equity. This indicates the financing mix of a company. It suggests how much debt a company has taken as compared to its owner's capital. This is also known as risk, gearing or a leverage ratio. Now, let's see what can be the ideal level for the debt and equity ratio.
The second parameter is the debt service coverage ratio. For this, we divide operating profit with interest expense and principal repayment. This tells how easily a company can pay back its dues.
Third important point is pledged shares by the promoters. Generally, promoters pledge their shares to take a loan, but it is important to see what proportion is pledged. For this, divide the pledged shares by total shares that promoters own. For example, if a promoter has a 70% holding in a company and 35% of it is pledged, then 50% of promoters' holding is pledged. This basically tells us how much holding of promoters have given as a collateral for taking a loan.
In recent times, Hindenburg Research has given a report against the Adani Group which stated that a large portion of promoters' share is pledged. The fourth parameter compares the profit margin with the interest rate. We get the operating margin by dividing the operating income by revenues. This suggests how much proportion of revenues companies earn as operating profit.
Fifth parameter is PE ratio, that is price to earnings ratio. Now, to calculate PE, the share price of a company is divided by the company's earnings per share. This EPS can be for past 12 months or expected EPS for next 12 months. This suggests at what price share is trading in the market as compared to the accounting earnings of a company. But even profit margins and PE, it is important to know their ideal level.
Now let us understand this with an example. For this, we can compare Adani Group with Mukesh Ambani's group. The debt to equity ratio of Adani Group companies is much higher than Reliance Industries. However, debt service coverage ratio, that is the capability to pay debt of Adani, is lower than Reliance. In these companies, the profit margin is lower than the interest rate. Promoters have pledged their shares and the PE valuation is 8.5 to 14 times higher than RIL.
So, we can conclude that if you trade in the share market for the short term, then you don't have to worry about all this. However, if you're investing a large amount for a long time, then you must assess companies on these parameters among various others.